Welcome to the Deep Dive, where we take complex financial sources and distill them into actionable knowledge, giving you a comprehensive understanding without all the heavy lifting.
And today we are really tackling a big one.
We certainly are. We're setting out to decode the foundational language of the market itself. This is our deep dive into technical analysis, and we're using the defining text of the field, John J. Murphy's Technical Analysis of the Financial Markets.
This book is, it's the blueprint. It really is. For anyone who wants to understand the how of market movement, the practical mechanics of price rather than just the why that you get from fundamentals.
And Murphy provides that definitive framework. He takes these classic principles of charting and just makes them so applicable to everything, from stocks to futures.
Everything. That's the key.
We should probably touch on his background because it's critical here. We're talking about 3 decades on the forefront of applying these techniques.
Oh, absolutely. He was a senior managed account trading advisor with Merrill Lynch.
And maybe most famously, the technical analyst for CNBC for 7 years. His authority is really unquestioned.
Right. And what's so compelling about this book, this source material, is that his earlier work was very focused on commodities and futures. But here, he universalizes those TA principles. He adapts them, and very successfully, to the broader world of stocks, indices, global financial markets.
He's basically showing us that a chart is a chart, right? It doesn't matter what the underlying asset is.
That's it, exactly.
Yeah.
And that universality is one of the great strengths of TA. So to start, let's define the discipline. Simply put, technical analysis is the art and science of studying market action, primarily using charts, for the explicit purpose of forecasting future price trends.
Okay, you highlighted market action. Let's clarify that for everyone listening, because that phrase is very specific in this context. It's not just the squiggly line on the graph, is it?
No, absolutely not. That's a common misconception. The term market action refers to 3 main sources of information. First and foremost is price.
Which includes the open, high, low, and close for whatever period you're looking at.
Correct. Second is volume, so the amount of trading activity. And third, and this is only for futures and options markets, is open interest, or OI.
So even though technicians might say price action and market action interchangeably,
Right.
we need to remember that volume and commitment, the open interest, are integral. They give context to the price movement itself.
They're the context. Without them, you're only seeing part of the story. Hashtag I. Introduction and Philosophical Foundation. Hashtag A. The 3 core philosophical premises of technical analysis.
Okay, so let's unpack this. We often hear TA defined by its tools, the trend lines, the indicators, but none of that really matters if you don't buy into the philosophical foundations.
That's right.
Murphy outlines 3 non-negotiable premises that really hold up the entire discipline. So what's the cornerstone?
The absolute non-negotiable cornerstone is this. Market action discounts everything. This is essentially the technical analyst's version of the efficient market hypothesis, or EMH. The premise is that the current market price reflects all known information.
All of it. So economic reports, political chaos, a company's earnings, even just the psychological mood of the crowd. It's all in the price.
It's all in the price. That's the belief.
So if that's true, doesn't that make fundamental research almost pointless? If a technician sees a stock soaring, they don't need to read the 50-page earnings report.
Exactly.
Because they just assume the market, as a collective, has already read it, understood it, and priced that good news in.
You've just hit on the great trade-off. Technicians argue that they don't need to know the cause. They only need to react to the effect.
And the effect is the price.
The effect is the price. A technician believes that by studying the price, they're studying the net result of supply and demand. If the price is going up, demand must be greater than supply.
Regardless of the reason.
Right. It doesn't matter if it's a great CEO or a surprise interest rate cut. The price tells the story. For a technician, chasing the why is often just too slow. You're reacting to old news.
That desire to track what's already happening, the existing momentum, that leads us right to the second premise, doesn't it? Prices move and trends.
It does. This is what makes charting a profitable endeavor in the first place. The whole discipline is built on the fact that price movements aren't random. They follow identifiable paths.
And this is based on an idea from physics, right? An object in motion.
A trend in motion will stay in motion. It continues in that same direction until some external force is big enough to reverse it. If the market were a true random walk, With no inertia or momentum, charting would be completely useless.
It's like the sheer weight of the market. It requires a significant opposing force to actually change its direction. Once the herd starts running, it takes a lot to stop it or turn it around.
And that inertia is exactly what technical analysis aims to capture and follow. I mean, at its core, successful technical trading is really just successful trend following.
Which brings us to the third premise, and this brings the psychology we hinted at right to the forefront. History repeats itself.
Exactly. This premise acknowledges the one constant, the human factor. Chart patterns are they're graphic representations of our collective emotional behavior.
Fear, greed, hope.
Fear, greed, optimism, panic, all of it. And since human psychology is remarkably constant, we react to gains and losses in very similar ways across decades. Technicians believe that when they see a well-known pattern, like a Head and Shoulders top,
Right.
they can predict the likely outcome, because that pattern reflects a specific, repeating psychological dynamic of distribution or accumulation that has played out, countless times over the past 100 years. #B, technical versus fundamental forecasting.
So this philosophical split, technical versus fundamental, this is really the great divide in market analysis. Let's really contrast these two approaches for anyone listening who's trying to get their head around it.
Okay, so the fundamental analyst focuses on the cause. They're trying to figure out the intrinsic value of an asset.
So they're digging into balance sheets, macroeconomic reports, supply and demand forecasts.
All of that. They're trying to determine what should be bought or sold. They are, at their heart, value hunters. They're looking for things that are priced below what they think they're truly worth.
And the technician?
The technician is focused on the effect.
The price movement itself.
Just the price.
Yeah.
Their goal isn't to determine intrinsic value, but to figure out when to buy or sell. They'd argue that a stock can be fundamentally undervalued for years, but the price just keeps dropping, and that's going to destroy your portfolio.
So fundamental analysis might tell you that XYZ company is a great value.
But only technical analysis can give you that optimal moment to pull the trigger.
So the core benefit of TA is timing. That's what it boils down to. Even the most committed fundamental investor, someone who's planning to hold for 10 years, they still need some kind of technical framework to optimize their entry point, don't they?
I'd say timing is almost a purely technical exercise.
Yeah.
Think about markets with high leverage, like futures or currency pairs. In those environments, if you're slightly wrong on your timing, even if your long-term fundamental idea is correct, you can get a margin call. You're out of the game.
Wow.
Technical analysis provides that necessary precision for your entry, your exit, and just as importantly, your stop-loss placement. It's an indispensable tool for managing risk, really, regardless of your underlying fundamental thesis.
And we mentioned this earlier, but another huge strength is its universal application. The same trendline principles that apply to charting the price of gold futures will work on a stock index or a crypto coin.
That is a defining feature. Unlike fundamental analysis, which requires really specialized knowledge for each sector. I mean, analyzing a tech company is a whole different ballgame from analyzing a copper futures contract.
Right.
The tools of TA trend lines, moving averages, support and resistance, they're equally effective across all trading mediums. The principles are tied to human psychology and supply and demand, which are constant across all markets and, importantly, all time dimensions.
From a 1-minute chart to a 50-year monthly chart.
Exactly. #C. Criticisms of technical analysis and the counterpoints.
Now, what's fascinating is that TA is not without its critics, especially in academia. We have to tackle the two main criticisms head on.
We do. And the first one is more of a psychological critique, the self-fulfilling prophecy.
I've heard this one. The idea that a pattern only works because enough people see it and act on it, which then causes the prediction to come true.
Right. Critics will argue that TA is subjective, that technicians are just victims of confirmation bias, seeing what they want to see in the charts.
That's a pretty powerful argument. So how do TA proponents counter that idea, that they're just creating the market move through herd behavior?
Well, the counterpoint really rests on two things: objectivity and wealth transfer. While, yes, TA does involve skill and some interpretation, the successful application of it relies on objective, measurable rules.
Like the exact calculation for a moving average crossover.
Exactly. Or the specific filters you use to validate a trendline break. If charting were purely subjective, then technicians wouldn't be able to consistently capture wealth from other market participants.
That makes sense.
The chart patterns, they argue, reflect a genuine underlying imbalance between supply and demand. The pattern itself is the result of that psychological imbalance, not just the cause of it.
Okay, so what about the second big challenge? This one is the academic heavy hitter, the random walk theory.
RWT, yeah. This theory claims that price changes are random and that historical data can't predict future movements. It's a cornerstone of the broader efficient market hypothesis.
This is where things get a little nuanced, right? The RWT suggests all available information is instantly priced in, so looking at past prices is useless.
It does. And that theory generally supports a simple buy and hold strategy, which is why it's so popular with passive index investors.
But the EMH itself is often broken down into three forms: weak, semi-strong, and strong. Which one is TA really arguing against?
This is a great point. TA generally accepts the semi-strong form of the EMH, which states that all public information is instantly reflected in price.
Which lines up perfectly with the first premise: market action discounts everything.
Perfectly. The real battleground is the weak form of the EMH. The weak form claims that historical price data is useless for prediction. And that's what technicians vehemently disagree with.
So what's the defense? How do technicians prove that observable patterns and trends actually exist?
They argue that the market noise, the short-term tick-by-tick fluctuations, that might appear random,
Okay.
but over the longer term, the tide, the intermediate and major trends, they're clearly visible. If prices really followed a random walk, long-term charts would never show these prolonged uptrends or downtrends. They just oscillate wildly without any persistence.
And the fact that trend-following systems can exist and be profitable over long periods?
Empirically disproves the weak form of the RWT.
It feels like the random walk theory kind of misses the human element, which we identified as the core driver of that third premise.
Precisely. And that's where the rise of behavioral finance comes in. It's the academic bridge that really validates a lot of what TA has been saying for a century. Behavioral finance recognizes that market participants are not always rational.
Not even close.
No. We're driven by herd mentality, by fear, by greed. And since those psychological factors lead to repeatable cycles of accumulation, which is buying, and distribution, which is selling, they create observable patterns and trends in price action. Price action isn't random because human reaction isn't random.
So now we can shift from the philosophy of charting to its historical bedrock, Dow theory.
The original text.
It really is. This framework, developed by Charles Dow starting in the late 19th century, is the original structure for modern trend analysis. It's the DNA from which all the subsequent technical tools have evolved.
And it's important to remember his original intent, right? He wasn't trying to predict the stock market.
No, he was trying to gauge the economic health of the country through stock averages. He saw it as a barometer of business conditions.
But in doing so, he established the language we still use today, the definition of a trend, how to classify market movements, and how to spot a reversal. Anyone serious about technical analysis has to internalize these principles, #TAG basic tenets of Dow theory.
So let's break down the 6 core principles that define the theory.
Okay, tenet 1 is just a reiteration of that main TA premise. The averages discount everything. Dow was very clear that the prices of the industrial and rail averages reflected the full spectrum of known information.
Simple enough. Number 2 is the vital classification of movement. The market has 3 trends. This gets at the time dimension of market action.
And this classification system is just foundational for avoiding the error of confusing short-term noise with long-term direction. We can use the ocean analogy.
Okay.
First, you have the primary trend. This is the ocean tide. It's the major long-term movement lasting more than a year, often several years. It determines if we're in a major bull or bear market. This is the trend that most long-term investors should be following. Second, the secondary or intermediate trend. These are the waves on the tide. There are significant corrections or rallies that move against the primary trend.
So a pullback in a bull market.
Exactly. They typically last 3 weeks to 3 months and often retrace about 1/3 to 2/3 of the preceding primary move. A secondary downtrend in a major bull market can feel brutal, but it's ultimately a correction, not a reversal.
And the third trend.
The minor or near-term trend. These are the ripples on the waves, short-term fluctuations lasting less than 3 weeks. These are generally irrelevant noise to the long-term investor, but they are absolutely critical for day traders and future speculators.
That distinction is so powerful, it immediately helps you avoid panic selling during a secondary correction within a primary bull market.
It provides the necessary context. Understanding the degree of the trend you're looking at is maybe the most important skill a technician can have.
Okay, now, Tenet 3 explains the psychological cycle behind that primary trend. Major trends have 3 phases: Let's explore those emotional cycles.
These phases describe the shifting participation and sentiment during a major market cycle. Let's use a bull market as an example.
Sure.
First, you have the accumulation phase. This happens at the bottom when the news is universally bad and the public is pessimistic or has already sold out.
This is where the smart money comes in.
Astute, informed investors. They begin to buy, quietly accumulating shares, because they see value despite the terrible sentiment. Volume is often low, activity is subdued.
Then comes phase two.
The public participation phase, or the rally. This is where the price starts moving definitively. Business news improves, and technically focused trend-following systems confirm the new trend.
And the public starts to notice.
The public starts to jump in, volume increases, and this middle phase is usually where the largest price gains happen.
And the final phase.
The distribution phase. This is where those informed investors who bought during the quiet accumulation phase start to liquidate their positions.
And what's the sentiment like here?
Overwhelmingly positive. You hear about a new paradigm or the greatest market ever. The public, driven by FOMO fear of missing out, rushes in, and you see heavy volume as the smart money distributes their holdings to all those latecomers.
This cycle just repeats endlessly. We saw it in the dot-com bubble, the housing bubble, and more recently with high-growth tech and crypto. The concept is psychologically eternal.
Absolutely. The lessons of accumulation and distribution are arguably more important than any specific indicator because they tell you where you are in the emotional life cycle of the trend.
Okay, tenet number 4 introduces the crucial mechanism for validity. The averages must confirm each other.
This is the historical link. Dow only considered a true major trend reversal confirmed when both the Dow Industrial Average and the rail, which later became the transportation average, broke their previous peaks or troughs.
So if the industrials broke out to a new high, but the transports were lagging behind.
The signal was questionable. The existing trend was considered to still be in effect. No confirmation, no signal.
And why the transports? What was the economic logic there?
The logic was really simple and elegant. Industrial companies produce goods. Transportation companies move them.
So we need both.
You need both. If the economy is genuinely expanding, production, the industrials, has to be matched by distribution and shipping the transports. If manufacturers are thriving, but no one's moving the physical goods, the economic strength is probably temporary or localized. The lack of confirmation meant the overall economic health wasn't robust enough to sustain that primary trend change.
Makes sense. Tenet 5 involves volume. Volume confirms the trend.
Volume is a secondary supportive indicator. It should always be heavier in the direction of the major trend.
So in an uptrend.
In an uptrend, you want to see high volume on the rallies and diminishing volume during the corrections. That suggests strong conviction in the buying. If a market rallies on really low volume, a technician is immediately skeptical of that move's sustainability.
And finally, that inertia principle again. A trend is assumed to be in effect until a definite signal reverses it.
This is the foundation of risk management. You stay with your position until the price action gives you a clear, unmistakable signal that the trend has changed. The objective of Dow theory, and really all of TA, is to identify these definite reversal signals as early as you possibly can. ##B, defining Dow reversal signals.
Okay, spotting that reversal signal is the hardest part. Let's focus on the 2 types of reversals Dow identified, starting with the strongest one, the failure swing. We need a clear, conversational way to understand this.
Okay, let's use a clear price example in a downtrend. A downtrend, by definition, is a series of lower peaks and lower troughs.
Right.
So step 1, the market is dropping and hits a low. We'll call that trough A. Step 2, it rallies, hits a peak, peak B, then drops again, breaking below trough A to hit a new lower low. That's trough C.
So far, so good. The downtrend is intact.
Intact. Now, step 3. The market attempts to rally again, but here's the key. It fails to exceed the previous rally peak, peak B. Let's call the second lower peak, peak D.
So it's a failed rally.
A failed rally. And then, step 4. The market turns down from peak D and breaks below the immediately preceding trough, trough C.
That failure to challenge the previous peak, followed by a break of the subsequent low, that's the definitive bear market signal. The buying power just couldn't sustain momentum, and the selling power reestablished control with a new low.
That failure to make a higher high, followed by a break below the previous low, is the textbook signal for a clear bearish continuation. And a bullish failure swing is just the exact opposite of that.
Okay, so what about the non-failure swing? That name alone sounds weaker or less decisive.
It is less decisive because the market manages to violate one of the primary rules for a moment. Let's imagine our downtrend again. The market rallies, and this time it does manage to exceed the previous secondary peak. Let's say it breaks above peak B, the previous resistance.
Okay, so that looks bullish for a second.
It does. But then the subsequent decline fails to break below the preceding low, which was trough C.
So the bulls achieved a higher high, which is a momentary win for them, but then the bears were unable to push the price to a new lower low, which is a major failure for the bears.
Exactly. It suggests the bears are losing control.
Yeah.
But because that rally was strong enough to penetrate the previous high, some Dow theorists view it as a confusing or weaker signal. It shows a clear shift in momentum, but maybe not a complete reversal until the price also exceeds the previous highest peak, which might be further back in time. #seed historical and modern applications. We should probably touch on some of the historical constraints. Dow strictly followed the closing price rule.
Meaning intraday price movements or penetrations of a level were just ignored.
Completely ignored. Only the closing price, which he saw as the final consensus of value for the day, was used to determine the trend status. Modern analysis still highly values the close, but we've obviously incorporated intraday volatility into our work.
And we noted that Dow's original purpose was as an economic indicator, a gauge of general business conditions, not a market predictor itself. Yet the theory has turned out to be remarkably effective at capturing the broad movements of the market.
Oh, its long-term track record is significant. It caught the 1929 top, and while it can be slow to signal the start of new trends because of that confirmation requirement, it has reliably defined the primary trends for over a century.
Let's discuss a critical modern application, Dow applied to futures trading. This is where that trend classification really becomes crucial.
This is a major distinction. Dow theory was designed for long-term investors following the primary trend. They can ride out those intermediate and minor corrections.
But in leveraged futures trading with high margin requirements, you absolutely cannot afford to ignore the minor trends, those ones lasting less than 3 weeks.
No way. If a futures contract is leveraged 20-1, a 5% minor trend correction against your position can result in a complete wipeout of your capital.
You're done.
You're done. So successful futures traders have to use technical analysis, not just for the major trend direction, but for high-precision timing of the minor trend for their entry and exit points. Technical skills are absolutely critical to survival in those highly leveraged environments, and it just proves the enduring, adaptable relevance of these basic trend classifications. So the chart is the technical analyst's battlefield. It is the raw data, just visualized.
Yeah.
And we need to be really meticulous about how this canvas is constructed because the way data is presented can fundamentally alter your interpretation.
We've established the 4 critical pieces of price data: the open, the high, the low, and the close. And the standard view for most technicians is the daily bar chart.
Right. The bar chart visually represents all 4 of those prices in a single vertical line. The full length of the line is the high to low range. The opening price is a small tick to the left. The closing price is a small tick to the right.
So it gives you immediate feedback on volatility, the length of the bar and sentiment, right? Where the close landed relative to the open in the overall range.
Instantly. Now, the simplest version, which is often used for quick trend recognition, is the line chart.
That's the one you see on the evening news.
It is. A line chart just plots the closing prices connected by a solid line. It's great for filtering out noise and focusing purely on the period's consensus value, but you sacrifice all the information about volatility and intraday activity.
Okay, what about the type that has just gained immense popularity in the last couple of decades, the candlestick chart?
Candlesticks, which originated in Japan hundreds of years ago, are fantastic psychological tools. They track the same 4 prices as a bar chart, but the visual emphasis is on the real body. That's the area between the open and the close.
And if the close is higher than the open, the body is hollow or white, a positive day.
And if the close is lower than the open, the body is filled in or black, a negative day.
The visual impact is immediate. You don't have to squint at tiny tick marks to gauge bullishness. The color and size of the body tells you instantly whether the bulls or the bears won that day.
Exactly. A tiny little body with long shadows, for example, that signals indecision. Whereas a long, solid white body with virtually no shadow signals overwhelming bullish conviction.
Finally, we have the highly specialized point and figure charting.
Point and figure, or PNF, is a really unique filtering technique. It completely ignores time and volume.
Wow, okay.
It only registers price movement in increments of a predefined box size. Rising prices are marked with X's, declining prices are marked with O's. It's a highly compressed format, and it's exceptionally good at defining support and resistance clusters and generating very precise buy and sell signals because it cuts out all that minor market noise. Its main use is in identifying horizontal patterns and calculating potential price objectives.
Now, this is a detail that often seems minor to a novice, but how you scale the vertical axis of your chart can literally change your interpretation of a long-term trend. We have the arithmetic scale and the logarithmic scale.
Right. The arithmetic scale is the default on most charting platforms. It uses equal vertical distance for equal price changes. So a move from $10 to $20, a $10 change, takes up the same physical space on the chart as the move from $100 to $110.
Which is also a $10 change. But the $10 to $20 move is a 100% gain, while the 100 to 110 move is only a 10% gain.
Exactly.
So on a multi-year chart, if a stock went from $5 to $500, the early 100% moves would look totally flat and insignificant, while the later 10% moves would look explosively steep. That's a massive visual distortion.
It's extremely misleading, and it can cause a technician to completely misinterpret the true momentum of a trend. And that's why the logarithmic scale, or semi-log scale, is preferred for long-range analysis.
For any chart covering more than 6 months to a year, you'd say.
At least. The log scale shows equal vertical distance for equal percentage changes.
So the log chart corrects that distortion. That 100% move from $10 to $20 now occupies the same vertical space as the 100% move from $50 to $100.
Correct. When you draw a long-term trend line on an arithmetic chart, it often appears to be accelerating exponentially, even if the rate of percentage growth is stable. On a log scale, that same sustainable trend will appear as a straight line, offering a much more accurate visualization of the trend's true steepness and sustainability. This is absolutely vital when you're analyzing primary trends over decades. #TC, volume and open interest in charting.
So price is the star of the show, but volume and open interest are the critical context. Let's focus on volume.
Volume is the total number of shares or contracts traded during the period. It's usually plotted as vertical bars right below the price chart. And as we learned from Dow theory, volume is the key confirmatory indicator.
So if price is rising on high volume,
The uptrend is validated. It shows participation and conviction. But if the price is rising on low, anemic volume, technicians get suspicious. The rally is likely weak, easily reversible, and it suggests a lack of broad market commitment.
open interest, that commitment measure, which is exclusive to futures and options.
OOI is the total number of outstanding unclosed contracts held by market participants. It's a measure of liquidity and market commitment. It builds up as a contract matures and then falls off as the contract gets closer to expiration.
Okay, here is a critical, actionable insight for futures traders, tying price, volume, and open interest together. What is the biggest red flag divergence involving these three?
The massive red flag is when you see price rising, but open interest is falling.
Okay, break that down.
Price is going up, which looks strong.
Yeah.
But the total number of contracts, the OII, is decreasing. What does that mean?
I don't know.
It means the rally is likely being fueled by short covering. Traders who were short are being forced to buy back their contracts to exit their losing positions. This is temporary, forced demand, not new buying interest entering the market. A trend based solely on short covering is completely unsustainable, and it's a major sign that the rally is weak and likely to collapse.
And conversely, price rising alongside rising open interest.
That indicates new money is flowing in and validating the uptrend. That's a healthy, sustainable move.
As we emphasized earlier, the importance of longer-range charts just cannot be overstated. We use daily charts for short-term timing, but the major trend always resides in those longer time frames.
Technicians really operate on a hierarchy. The daily chart gives you incredible detail, but it also gives you a lot of noise.
The ripples.
The ripples, exactly. A weekly chart compresses a week's worth of activity into a single bar, filtering out those minor ripples and providing a much clearer view of the intermediate trend. And a monthly chart, which can easily cover 20 or 30 years, provides the indispensable long-range context for the major trend.
So, before placing any trade based on a daily chart signal, the successful technician first steps back and checks the weekly and monthly charts to confirm the direction of the underlying tide.
You have to. You want to avoid the common and very costly mistake of trading against the major trend based on a temporary signal you saw on a short-term chart. The longer the time frame, the more reliable the technical signal. The long-range view prevents the daily noise from misleading your decision-making. #TagYV. Basic concepts of trend in key tools.
Okay, we've built the canvas and established the philosophical rules. Now we move to the foundational tools used to interpret the market's behavior.
Right, the building blocks.
Starting with the most basic, trend direction. #TagA, trend direction and classification.
The three directions of movement are simple, but it's crucial to define them.
Yep.
First, the uptrend.
Successively higher peaks and troughs, the definition of bullishness.
Second, the downtrend. Successively lower peaks and troughs, the definition of bearishness.
And third,
Sideways or trendless. This is when you have horizontal peaks and troughs. It's a consolidation or a trading range where supply and demand are in balance. It often precedes a major breakout in one direction or the other.
and building on Dow theory, we classify the degree of these movements: major, intermediate, and near term.
And these three classifications help us select the appropriate trading strategy. The major trend, lasting months to years, dictates your long-term holding direction.
Right.
The intermediate trend, 3 weeks to 3 months, is where most swing trading systems operate. They're often focusing on the corrective phases within that major trend.
And the near term?
The near-term trend, less than 2 or 3 weeks, is the short-term tactical window used for high-frequency timing. A well-informed technician always knows which degree of trend they are analyzing at any given moment. #TagB, support and resistance.
SR. Support and resistance are maybe the most visceral concepts in charting. They are psychological battlegrounds. How do we define them, just simply put?
They are price levels where the collective supply and demand dynamics shift decisively. So, support is a price level below the current market where buying interest overwhelms selling. It often pauses or reverses a decline.
And this is usually where you find previous reaction lows or troughs clustered together.
Exactly. And resistance is a price level above the current market where selling pressure overwhelms buying and it halts a rally. This is usually where previous reaction highs or peaks are clustered.
What's so fascinating here is the psychological mechanism behind SR. It's not just a line on a chart, it's this clustering of fear, relief, and regret. Let's imagine a stock peaked at $50. That's our resistance level. How do the three key groups of market participants reinforce that $50 ceiling?
It's a classic phenomenon, and it's driven by three distinct groups. First, you have the longs, the regretful buyers.
These are people who bought stock near the $50 peak.
Right. The price has against dropped, and they are now holding a loss. When the price rallies back up toward 50, they feel immense relief. Their primary goal is just to get their money back. So they liquidate, they sell their position at or near $50, adding supply exactly at that resistance level.
Okay, group one adds supply. Who's next?
Group two, the shorts, the regretful sellers. These are people who successfully shorted the stock near 50. They now regret not having sold more or sold higher. When the price approaches 50 again, they are encouraged to short more, adding new selling pressure, new supply at that level.
Okay, so that's two groups selling at 50. What about the third group?
The third group is the uncommitted, the regretful non-participants. These are the people who sat out the entire rally and the decline. They resolve that if they get a chance to buy this stock at the previous high of $50, they will finally enter the market. When the price hits 50, they become buyers, creating demand.
Wait, I thought resistance was defined by selling. Why are the uncommitted adding demand at 50?
And that's where the crucial role reversal comes in. The uncommitted are the minority force that is reinforcing the resistance in anticipation of a breakout. But when that resistance is broken, when the price decisively closes above $50, the psychology of the longs and the shorts flips entirely.
So when $50 is broken, the old ceiling becomes the new floor. Why does that old resistance now act as strong support?
Because the groups who missed out or made the wrong trade now completely dominate the action. First, the longs who finally sold at $50, their break-even point, now they regret missing the subsequent breakout. They resolve to buy back on the first pullback to that old $50 level.
They want back in.
They want back in. Second, the shorts who shorted at 50 or below are now trapped. They're holding losses. If the stock pulls back toward 50, they're desperate to cover their short positions, which means buying back at that old resistance line to limit their losses.
So they're adding more demand.
And finally, the uncommitted who are waiting to buy are now certain that 50 is a strong level, and they execute their original buy orders. All three groups converge to create this massive clustered demand or support at the former resistance level. This role reversal is perhaps the most fundamental psychological truth in all of technical analysis.
And we can't forget the power of round numbers in reinforcing these levels, can we?
No, round numbers are inherent psychological attractors. Traders target 10, 25, 50, 100, 1,000. These price levels often act as major SR simply because human beings tend to place their orders, their targets, and their protective stops at these easily quantifiable figures. The S&P 500 index hitting 5,000, for example, was a massive psychological barrier that required immense momentum to break through.
Now, for the technician's simplest and maybe most valuable tool, the trend line. How do we draw an effective, reliable trend line?
A trend line is just a straight line that connects successive peaks or troughs, and it defines the linear direction of the market. An uptrend line connects at least two successive reaction lows, or troughs, and it extends upward and to the right. A downtrend line connects at least two successive rally peaks and extends downward and to the right.
So we established the line with 2 points, but Murphy really emphasizes the third touch for validation.
He does. The line requires 2 points to draw, but it is only considered valid, a true indicator of trend direction, if it is touched and successfully tested a third time. The more times a valid trend line is tested without being broken, the more significant that line becomes.
And the more powerful the reversal signal will be when it finally does break.
Absolutely.
So when that validated line breaks, it signals a trend change. But technicians have to deal with whipsaws, these false breaks that reverse quickly. We need filters to confirm the penetration is real. What are the standard filters?
We rely on price filters and time filters. First is the 3% penetration rule, which is a price filter. This rule, which is applied mainly to futures and indices, requires the price to close 3% beyond the trend line for the break to be considered valid.
So if a trend line is broken at $400,
The close must be at $388 or lower to confirm that downside break.
wait, why 3%? Why not 5 or 1? Is that number just arbitrary?
It's not arbitrary, it's statistically derived. The 3% rule is a way of statistically accounting for normal market volatility. It tries to filter out the common daily noise, the ripples that often cause temporary violations. That specific percentage is based on historical volatility studies designed to minimize the false signal rate. It's a pragmatic, rule-based approach to filter out psychological noise.
Okay, so that's the price filter. What about the time filter?
That's the 2-day rule. This is the most popular time filter. The price must close beyond the trend line for 2 consecutive days for the break to be considered valid. A close above or below the line on a single day is often viewed as tentative, but 2 days of sustained action confirms that the market consensus has genuinely shifted away from the existing trend. Hashtag DENIUM, Advanced Trendline Concepts. So technicians have adapted the basic trend line to provide more nuanced insights into momentum. Let's start with the fan principle.
This sounds a little complex. How does the market create a fan of trend lines?
Let's imagine a strong uptrend. The first, steepest trend line, we'll call it line 1, is broken. The price corrects, it bounces off some support, and it rallies again. But now the momentum is weaker, so the technician has to draw a second, flatter trend line 2, from that same original trough. When line 2 is eventually broken, the price declines further. And on the next rally attempt, a third, even flatter trend line 3, is drawn. The key takeaway here is that when the third and final trend line in that fan is broken, it usually signals a strong and confirmed reversal of the major trend. It shows a progressive decay of market momentum.
And that decay in momentum leads us to the relative steepness of the trend line. Is there an unsustainable angle?
Historically, yes. A 45-degree angle often represents the most sustainable, balanced rate of advance or decline.
So if a trend line is significantly steeper than 45 degrees,
It suggests the trend is generally unsustainable. It's running too hot, it's driven by euphoria, and it's likely heading for a sharp correction. And conversely, a line that is too flat suggests a weak trend that might just collapse into a sideways consolidation.
what if the trend is accelerating, say after a big breakout? How does the chartist track that without waiting for a new base to form?
By drawing accelerated trend lines. If the market momentum increases dramatically, the technician has to draw a new, steeper trend line to track the move more closely. And they focus on the steepest one for risk management.
So when that steepest accelerated line breaks,
It's an early warning. It tells you that the exponential phase of the rally is over, even if the primary flatter trend line is still intact.
okay, finally, the channel line or the return line. How does this expand the utility of the basic trend line?
The channel line provides a boundary for profit-taking and an early warning of weakness. Is drawn parallel to the basic trend line. So in an uptrend, after you connect the troughs, you project a parallel line from the first prominent rally peak. This creates a defined price channel.
So when the price hits that upper channel line, it's generally a safe bet for some short-term profit taking.
Yes. Hitting the channel line often signals an extreme point in the market's current trajectory, and it acts as temporary resistance. But more importantly, if the price fails to reach the channel line on successive rallies, it's a strong indication that the trend is running out of steam and momentum is slowing down, even before the main trend line connecting the lows is violated. Hashtag tag V. Conclusion and final thought. So this deep dive has really established the philosophical bedrock of technical analysis. That conviction that market action discounts everything, that prices move in trends, and that history repeats itself because of persistent human psychology.
Right. And we honored the historical foundation of Dow theory, understanding its 6 tenets, its 3 trends, and the absolute necessity of that dual confirmation between the averages.
We also built out the technician's toolkit. We learned why logarithmic scaling is so essential for long-term vision, how candlesticks convey instant psychological information, and that critical insight that volume and open interest divergence can signal the fragility of a rally.
And most importantly, we broke down how support and resistance are not just price points on a chart, but are these psychological anchors that reverse their roles once they're penetrated.
We also focused on the practical application of trend lines, recognizing that they require the test of 3 touches for validity. We covered the necessary filters, like the 3% price rule and the 2-day time rule, that prevent whipsaws and confirm that a break is genuine, not just market noise.
The essential takeaway here is that you don't need a PhD in corporate finance to understand the market's consensus. You simply need the ability to read the patterns structured by supply, demand, fear, and greed.
That's right. The language of the market is universal, and it's consistent.
So, given the reliance on objective rules, that 3 touch rule for validation, and the need for the 3% or 2-day filter to confirm a break, consider this because this is where the money is won or lost. How often do you think the psychological pressure of the fear of missing out, or FOMO, causes a new trader to ignore the necessity of waiting for that second confirm close beyond a critical trend line, confusing a minor price correction within a major trend with the definitive signal of a complete reversal? And what happens to their account when that trend resumes its original major direction?